week that I get my boss called me in, said they had run into cash flow issues and they were going to have to lay me off. And this was like 2 weeks before Christmas. And I was part-time trading at the time. I was trading off of my phone, and when I was home, I'd be doing some futures trading and stuff at night. But I couldn't full-time trade with a job, of course. But I had been studying it for a good long time, studying options and trading. You know, I was investing in doing covered calls and things like that. But anyway, he had to lay me off, and so I figured that was a pretty good opportunity to go ahead and start trading full-time. And it's a big change when you don't have an income. So December was kind of slow. I made a little bit of money. It wasn't very dramatic, but again, seasonally it's a tough time to trade. But January had a very good month, and then February, about halfway through the month, I had another really good month. And my boss, who was, like I said, was a friend of mine, he called me back and called me and told me that the cash flow had been resolved. They got things straightened out, and I could come on back to work on Monday. And I told him how much I appreciated that, but because of the way that the trading was going, I couldn't really afford to come back and work for him anymore. And we left it at that. And that's how it started. It was just I was kind of forced into it. A lot of folks, when they go from part-time to full-time trading, they have some criteria they want to hit. You know, they want to hit targets for certain profitability for a certain number of months and build up a certain amount of cash. But I couldn't do that, and that's how I switched. That's how I switched into it, and that's how I got started. And I've been doing it full time since then for 15 years. All right, so let's see. It's about time to get ready to get going here. So we'll get started. So again, thanks everybody for coming to the webinar today. I appreciate it. My name is Dave. I run the Options Live Trading Room that we use based on what's called the SPY Super System software, which I'll show you. But basically, that's a piece of software that identifies when institutions are in the trades and when they're not. And basically, what we're doing is following the institutions. That's how you make money in the market, is to be trading with the institutions, not against them, and not in there when they're not in there. And I also have my trading room is active from market open to market close 5 days a week. So I'm always there. Answering a lot of questions on traders, looking at charts, going over trades that other traders are interested in. So we spend a lot of time trying to educate folks on how to become consistently profitable. And then I have a text alert service, which is for folks who can't be in the room or don't want to be in the room, where we send out alerts on the highest probability trade setups when we find them. We don't do a lot of these now. We're not taking 5, 6, 7 trades a day. A lot of times on the text services, you might have 2 one day, and then none for 2 or 3 days, then maybe another one. So, you know, most of the time for the text service, we don't have any more than 5 trades, maybe 6 at the most on at one time. All right, so let's get started here. And again, first thing I have to do, of course, is a disclaimer. All signals and trading opportunities we provide here are for educational and demonstration purposes only. Trading is very risky, so you should never trade you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. All right. So by the way, if you have any questions, you can put your, I can't answer them, or you want to talk more about the specific software that would come from the corporate folks, you can just put your name and phone number in the question box or the chat box, or your Skype username, and Rory will give you a call back. He's be on the webinar today, but he'll give you a call back and just answer your questions. He's not going to pressure you or anything. He just calls you one time just to answer any questions that you might have. Okay, and that's his phone number right there. And I'll put this up again at the end of the webinar. All right, and it's just some graphics here. This is about the SPY Super System explained. I'm going to show you that this is what it looks like. It's installed on Thinkorswim, on the Thinkorswim platform, but it looks quite a bit different, and I'll show you that as we go forward here. And that's a graphic of the alert service. It comes on your phone. That's obviously an SMS text alert service. It comes to your telephone, and when we take high probability trades, you get them pretty quickly. I'm on the alert service, so I can track how fast the alerts go, and usually it takes about 10 seconds or 15 seconds, depending on your carrier, to get the trades. All right, now I'm going to go into details on how we handle this text alert service. This, by the way, is most people do this stuff at the end. They take you through the webinar first, and then they give you what the offer is at the end. I'm going to put it up front here so we know what we're talking about. I have the live trading room and I have the text alert service. Typically, these are individual subscriptions, and usually you take them for a year or forever or 3 months. But for this special, they're running buy one get one free, so you get access to both the trading room and the text alert service. There's a few three different things here. If you take the free week, you can get a 2-week free trial. And then after that, after the 2-week trial, you would go over to a quarterly subscription at $5.94. And that comes with the text alerts, the trading room. You also get all my videos. If you want to go right into the room in the text alert service, this is the annual access right here, $17.94, and you get a Discord room as well. We have 2 other professional traders that are in the Discord room all day, that you have access to that, as well as all the videos that we have. I have about 28 videos, so you get the text alert service and the trading room. And then the one-time payment. This is for lifetime. You can get the alert service and the trading room for forever for one price, which is pretty nice. So we actually have quite a few people do that. But again, the big deal here is it's buy one get one free. We separated out the alert service and trading room. Usually the separate subscriptions, you get them both for one price now. All right, so let's this is what I start every webinar with. So if you've heard it, bear with me because I know it'll be redundant. But this basically is an explanation of what drives the markets. And it's important to understand what drives the markets, because that's how we're going to make money in the market, is to be in there when institutions are in there. And this is a graphic depiction of these little marbles. These are retail traders such as myself and likely everybody else here. And retail traders, it's important to understand, we don't have any impact on driving the market. We don't create trends. We don't break trends. All we do when we're retail traders are in the trades by themselves is just create a lot of chaos and a lot of chop. So if you're in there with just retail traders when institutions aren't trading it, then you're just going to end up with a lot of chop and a lot of frustration. The big marble here, this is the institutions. Now it's really important to understand when I say institutions what I'm talking about. Most people know that institutions are JP Morgan, Goldman Sachs, HSBC, all of the big investment banks. This is a big part of the institutions. And it's also important to understand that institutions have trading desks where they actually have humans. And then they have algos, which is where most of their trades come from. Most of the institutional trades are done by computer programs. They're done by what's called algos. I'm sure you've heard algos called. You've heard of algos. And the institutional banks, and including hedge funds, also have these algos. And one way to notice that the algos are actually doing something, if you take, for example, like on a Friday when the jobs report comes out. Jobs report comes out at 8:30, while the FOMC, when the Fed makes their announcement at 2 o'clock on Wednesday, which they'll be doing. If you look at the market and look at, for example, the S&P or the Qs, look at the indexes and watch the move that they make and how fast that move occurs. And you're going to find that like the FOMC comes out at 2 o'clock. At 2 o'clock in 1 second, the market is going to be shooting up or shooting down. Now, those are not humans that are trading that. That's the algos. The algos can read they optically read the FOMC report, and they generate trades in milliseconds off of those reports. So that's lets you know that algos are actually trading that. They trade off of news. They trade off of they actually have programs written to undermine retail traders by taking strategies that they know they use, such as MACD crossovers, and they write software to break that. So that's what the institutions are. Now they're also made up of hedge funds, they're made up of pension funds, and they're made up of mutual funds such as Vanguard and T. Rowe Price. So there's billions and billions of dollars out here that institutions have to invest in to trade. And our job with the SPY Super System software is to identify when there's a large amount of institutions pushing its trade one way or the other. The institutions can be in there in trading, but they don't necessarily have to be in there in a large enough quantity or a large enough group to be actually able to drive the price. So that's what we have to find. All right, so that's what drives the market. It's our job to only be in the market when institutions are driving a stock that we want to trade. Okay, so in the room and in the alert service, I have a couple of rules to trade by. These are really pretty basic. They're going to seem simple. We trade the best and skip the rest. So that sounds easy, but you have to be able to find the rest, find the best and skip the rest. It's important to understand what makes up the best trades, and we'll go over the criteria that we use for that. The other thing I note here, and I say this in the room all the time, our objective is not to make trades. Our objective is to make money. All right, and this is meant to discourage traders from over trading, because that's one of the biggest banes, one of the biggest problems that retail traders have is they trade too much. They take too many trades during the day. They've got too many trades on. They're trying to manage them, and if they just can't sit there and wait for the trades to set up, they get impatient. And this is what I try to instill in traders, that your objective is just to make money, not to make trades. So not taking a trade a lot of times is the best trade. So again, we want to maintain discipline. This is following a strategy. We have a criteria and strategy that we follow. You only want to take trades that fall into that, and remain patient. This is a really hard thing for retail traders to do. If they're sitting in front of their computer and an hour goes by and they haven't taken a trade, they really get antsy. They want to push that mouse, they want to buy something, or they want to sell something. They just can't sit there and watch. And when you have markets like we had the last 3 days, which are just gap and chop, then it's really, really difficult, because you may have a good trade and then you're going to bleed it all the way on little trades all the rest of the day. So remain patient, really critical. Okay, now as a profitable retail traders, we need an edge. Now we need an edge over other retail traders. All right, we're not going to take money from institutions. All right, we're going to take money from other retail traders who don't have the same tools that we've got. They don't have basically the weapons. If you think about trading, retail traders are going up against other retail traders. That's who we're taking money from. If you've got better equipment or better weapons than they do, you're going to beat them. And we're going in here with probably the best weapons you can get, which is being able to identify when institutions are in there, and strategies that I know work 85 to 90% of the time. And so we're in there with tanks, and the other retail traders are in there with pea shooters, and we're going to take their money. All right, so our edges, we have the right line compass system. This is actually called the SPY super system now, but the actual original system was called the right line compass system, which we've enhanced to be the SPY super system. So we have that, so we can identify when institutions are in there. We also trade relative strength and relative weakness. Now, this is not to be confused with RSI. Relative strength, as is defined, is how is your stock trading versus the S&P 500 or the triple Qs. If you're looking at the SPY and it's moving sideways and down on 5-minute charts, and you've got a stock that's stacking green candles, you've got relative strength, and vice versa on relative weakness. Why this is important is if you take a trade that has relative strength and the SPY turns around and heads down, and your stock is not going to fall as much as it would if it didn't have relative strength, because it's obviously outperforming the SPY. So this is another important criteria. Then we want to trade with the market trend if there is one. There hasn't been an awful lot of good trending days, but Friday was actually a bearish trending day, one of the few trending days we've had in a while. But we want to trade in that direction, right? And then we want to buy near support and sell near resistance. This is really important, because if you're buying near support and then selling near resistance, if you're getting into a trade right near a support level, your downside risk is minimized by a lot, because it doesn't have to break down much and you're going to be out. If you chase it and the stock is quite a ways away from support, you've got to wait for it to come all the way back to support. Then if it breaks down, you've lost a lot more money when that happens. All right, so those are 4 key elements that gives us an edge. Now, the compass system, or the SPY super system, identifies the highest probability trade setups, while sidestepping setups that look good, that are going to fail more often than they succeed. All right, this is critical, and it does this by identifying when the institutions are driving the move and when they're not. All right, so this is what gives us such a big edge over everybody else. Now, the software, the SPY super system, or basically the Compass software, it analyzes complex trading data and it displays the results in easily identifiable visual format. And this is really important because being able to identify when institutions are in trades and when they're not, if you're trying to dig into a lot of really complex data, you're just not going to be able to do it. And so the fact that the Compass system or the SPY super system does this and then makes it visible in colors on a chart, even relatively new traders are going to be able to identify when the institutions are in the trade and when they're not. And you'll see that as we go forward here. All right, so again, we get an edge over retail traders. We're only taking trades that are being driven by institutions. I keep saying this. This is critical. We trade stocks that have relative strength or relative weakness versus the SPY or the Qs, and we trade in the direction of the overall market. All right, so that's what we're looking to do. How does this give us an edge? Well, our trades are going to be supported by institutional buying and selling. So basically, we're just following the institutions. We're picking up their breadcrumbs or their dollars and behind it. We're not trying to beat them. And the stocks are going to be outperforming the SPY, and they're going to be moving in the direction of the overall market. This is where our edge is, and this is what the software allows us to do. And we take that and we convert that into a methodology that we can trade based on all of this information. Okay, just to kind of let you know what we consider high probability trade setups. I have this virtual funnel. This is really just a thought process we go through when we're looking for a trade. This is something that a lot of traders overlook, this first one. If you're going to go long a stock, and I'm not talking about scalping, I'm talking about a stock that you want to be in for a few hours or overnight or a couple of weeks, you've got to start with the daily chart. The daily chart, if you're going long, has got to be bullish. If you're trading long with a bearish daily chart, you have no staying power. You cannot stay in that trade. If this trade goes against you that day, you got to get out. You certainly can't hold it overnight. So it's very important when you're going to take a trade, if you like it long, make sure the daily chart is aligned bullishly. And then you look at the 5-minute chart and try to find a good entry into it by finding a bullish entry on the 5-minute. So that's why I say the daily and 5-minute need to be aligned. And this is really important. A lot of traders don't even, I can't tell you how many times I get traders asking about taking a particular trade long, and we bring up the daily chart and they haven't even looked at it. They're just looking at the 5-minute chart going long, and you look at the daily chart and it's terrible. It's bearish. And I try to explain that when they show the stock, when they express an interest in the stock, I'll put the chart up there and show them what it looks like on the daily, and then they can kind of see it. But the problem is you've got to do that right when you start. Okay, and we're going to trade with the trend, both the stock and the market trend. Obviously, if we get a stock that's bullish and the market's bullish, that's even better. Then we're going to look at the Compass indicators, or the SPY super system indicators. These have got to be aligned. And the two key ones that I'm going to talk about are the current time frame momentum and the multi-time frame momentum. Those are very, very critical, and they need to be aligned bullish for longs and bearish for shorts. Then we look at relative strength and relative weakness, as I've said before, and then you look to enter near support or near resistance. Now, if all of these are true, but it's not near support, then typically what I do is I put an alert on my chart to let me know when that support or resistance level is reached, and then I can reevaluate the trade at that point. All right, so that's the high probability trade setup funnel that basically is virtual. This is just a thought process we go through. And again, this is just got this funnel method written out here. Again, stock to be traded should have the daily and 5-minute chart aligned. I've highlighted that. And the Compass indicators, or the SPY super system indicators, must align in the direction of the trade that you're going to take. Really, really important. One little key point is on the 5-minute chart. When you're trading long, there's an indicator called the VWAP, the volume weighted average price that all the institutions use. When you're going to go long a stock, on the 5-minute chart, the price should be above the VWAP. If you're going to go short, it should be below the VWAP. Don't be trading long a stock when the current 5-minute chart is below the VWAP. Wait for it to break above the VWAP and become more bullish. Now the VWAP only applies, I only use it on the 5-minute chart. I do not use it on the daily chart. And again, I have patience. That shows up a lot in a lot of the stuff that we talk about in the room. Having patience, critical. All right, so these are the strategies that we use in the room for most of the trades we take are options. We do take straight calls and straight puts, of course. That's the majority of them. Probably in the neighborhood of 65, 70, 75% would be straight calls and straight puts. Debit spreads, we do that using weekly options. Expiration, this is a little unusual. Most people go out in time on debit spreads. I don't. I use weekly expiration. The ROI is better. You don't have too much. If it goes against you, you don't have the time to recover. But if it goes in your favor, you can make a lot more money in a weekly basis than you would going out 2 or 3 or 4 weeks. Then I also do what's called time spreads or calendar spreads. This is done over earnings. Right after, you have to take this just before earnings come out. This is a non-directional trade. It's not. I don't care if the market, if the stock goes up or goes down. We're just capturing the volatility crush after earnings are released. And then we have something called the weekly ATM strategy. This is basically selling puts on neutral to bullish stocks week after week, while we maintain a protective position by buying a longer dated long put further out in time below our put strikes that we're selling, just in case the stock turns against us. The long put will protect us. All right, and we do regular credit spreads, basically credit spreads on put credit spreads and call credit spreads, just to capture premium on stocks that we expect to stay above or below a certain strike price by expiration. And then we have another. This is they call the SPY Super System. This is the methodology using the software. These are very high probability trade setups that we do only on the 5-minute chart, and we do them on the SPY, the Qs, and the IWM, the indexes. All right, and this is extremely profitable. These trades are pretty quick, and you're only in one trade at a time. And I'm going to go over some of the results we've had with this, because one of the reasons I put this in is because the traders not being able to be patient. They're taking trades when they shouldn't be taking trades. So to kind of offset that, this particular methodology is great for intraday trades, and you can just have one on at a time. And while you're waiting for a swing type trade to set up, this is what we use, and we have really good results with this. Okay. Rain, will be sending out a recording of today's webinar? Yes. Yeah, everybody who's registered will get a recording of this. All right, so those are the strategies we use. I'm going to talk in detail about this one right here in the upcoming webinar today. The alert service, this is for folks who are interested in the alert service. It's designed for day trades and short-term swing trades. This is not investment advice. This is for stock trades that are going to last today, the day we enter them, up to about 3 weeks. Just depends on the price action and the particular stock. But that's what it's for. It's obviously designed for traders who don't want to or can't watch the market all day. And you're going to get real-time alerts on the highest probability trade setups. Now, we do take trades in the room that I don't put alerts out on, because it's several different reasons. One, a lot of times if the trade's going to be on for, let's say it's going to be, I expect the stock to move really quickly in the next 15 minutes to a half an hour, I'm not going to alert on that. That doesn't give the alert members time enough to react to it. And then if I take a trade like at 3:50, 10 minutes at 4 in the afternoon, I'm not going to alert on that either. All right, because I'm trying to just alert on the very highest probability trade setups, because I can't take anything too speculative on alerts, because you don't have time on the alert. You get the alert, you may not see it for a while. So it's really important to make sure those are really high probability trade setups. And the high probability trades are, we do this by identifying institutional involvement. As I said, the institutions have to be driving this trade. And then when I look at market internals, which is basically looking at the volume of stocks going up minus the volume of stocks going down across the whole market, and if that is neutral or bullish, I'm okay for a long. If it's neutral to bearish, I'm okay for a short, based on the institution. So this is the most important thing. The institutions have to be in the trade before I'll take it. And then we do some more deep technical analysis on the trade to find the best ones. All right, this is the equity curve for the alert service going back to March of 23. This just really kind of shows what the equity curve looks like. It obviously goes from bottom left to upper right. This is based on putting $2,000 into each trade. That's just an arbitrary number I use to come up with numbers so I can compare them month to month. But this is what the equity curve looked like. Okay, now I want to talk about options here. I'm gonna put it right here in this spot because I want to get this covered because I know a lot of people came here to maybe get some refresher on options, to learn about options, and then we'll go into all of the statistics of the trades we've taken and the strategies, etc. All right, so let's go through options. Now, and a lot of this is going to seem really redundant to folks who know options, but there are people here who are just trying to learn options, so I just want to cover some of the basics. This is what's called an option chain, what you're looking at right here. And the two key elements right here is the dates across the top. This is back from March, but this is on Bristol Myers. So Bristol Myers right here was trading at 53.79. This is the option chain, this whole thing. This is the expiration date. So this is where you would click on the expiration that you want to take. And this is the strike price. What strike price do I want to take? If I wanted to buy an April 5th or a March 15th call on Bristol Myers, these are the calls. These are the puts. Calls are on the left. And the stock price is at 53.79. See, it's this 54 is highlighted. That's the at the money option price, right? 54, March 15th. The bid price was 61 cents and the ask price was 66. This is what somebody's bidding on it. This is what somebody's asking. If you were to try to buy that right now, you would probably buy it for around 63 or 64 cents, which, by the way, is $64. You multiply the actual option price by 100, right? Because it covers 100 shares. This would be for one share. All options are based on 100 shares. So 61 to 66 is the price on the bid. This is the bid. This is the ask. And these are the calls, and these are the puts. And the puts, the 54 was 79 bid and 83 ask. Notice it's a little bit higher than the calls. That's because the stock price is actually already below $54, but this is the closest one. The one other thing to look at in here is the thing called the delta. This is the delta, and you see the delta numbers right here. Notice the delta on the 54 call is 52, and on the 54 put it's 48. These always add up to 100. And what this tells you, the delta tells you how much your option price is going to move based on the stock price moving $1. So if the stock price moves up $1 from here, your option price is going to go up 52 cents, so $52 for your whole contract. So it moves 52. Now you notice the $53 call, which these are considered in the money because the stock is above that price. Notice the delta is 71. So for every dollar that the stock price moves up, your $53 call will go up $71. All right, instead of 52. And the deeper in the money you go, the higher that delta becomes, the more that option price moves based on the stock moving up $1. But of course, they cost more money. You can see that. All right. So that's the calls. That's the puts. This is the expiration dates. This is the strike price. These are the things that are important. The one other thing that I'm showing here is what's called OI and VOL. This is open interest and volume. This shows you how many contracts have been traded today on that particular strike price, on that particular expiration date. So if I'm looking at Bristol Myers here, if I'm looking at the $51 calls, for example, there was 106 $51 calls either bought or sold. The big number down here is called the open interest. This is how many contracts were open when the day started. This does not change during the day. At 9:30, this is at 1892. At 3:59, this is at 1892. This doesn't change until the next day now. That's how many contracts are available now, or we're outstanding. The reason this is helpful is because the higher this number is, when you get 500 or 1,000 or 2,000 open interest, when you're trying to get into a trade and get out of a trade, it's going to be much easier to do it than if there was only 10, because it's called liquidity. And if there's more contracts that are out there, you're much more likely to be able to buy or sell. All right. All right, so there's your calls, there's your puts, there's your expiration dates, and these are strike prices. Strike prices are in the money, that are below on the calls. Anything less than the current strike price, a current stock price is in the money. Anything higher is out of the money, and opposite on the puts. All right, opposites are this is out of the money because the stock hasn't fallen that far. Anything above 54 is in the money, and you notice that the deltas keep going up on the in the money and down and out of the money. All right, so that's options. Now, what we're going to talk about here, what are options? Well, they're basically derivatives. They're obviously they're derived from the actual stocks. What makes up the premiums? We're going to talk about intrinsic versus extrinsic value. We're going to talk a little bit about the Greeks. Strike price and expiration date we've already covered. Volume and open interest we've already covered. And I'll try and go across the primary option trades that I use, or at least that are available. And I'm going to also give you a list of the bullish option strategies and the bearish option strategies and the neutral option strategies. And this is very helpful because if you like a stock bullishly and you want to trade options, you have some different options on those options that you can take. So I'm going to give you a list of which would be bullish options, which would be bearish option strategies, and what would be neutral option strategies. All right, we'll cover that. We'll cover a little bit about the trade setups. I'm not going to get into too much detail on this. Takes a little bit too long. Okay, so options can be bought or sold. It's pretty simple. And you can buy calls and you can buy puts, or you can sell calls and sell puts. So calls, if you're buying a call, you're looking for the stock to go up. That's basically going long. When you're buying a put, you're looking for the stock to go down. This is as basic as it gets. You like a stock long, you want to buy a call at some expiration date at some strike price. If you think the stock is going to go down, you want to buy a put, all right, or puts. So all option strategies are made up of just calls and puts, and you can buy them or you can sell them. Right? You can buy calls and sell puts, sell calls. You can buy or sell either one. Now this is really important to understand because buying calls and buying puts, they come with a right. They give you the right to buy that stock or sell that stock at a specific price by a specific date, by your expiration date. You have the right to do it. You don't have to do it. Okay. When you sell a put or you sell a call, you have the obligation to supply that stock to the person who bought the put or the call from you at whatever price that strike price was made. Now this is really important to understand because this is what ends up with assignment. You're getting stocks assigned to your account because you sold the put. Let's say you sold a Microsoft $100 put and the stock went down to 95, say, and you sold a put at a 100, then you're going to be obligated to supply that stock. And it's the same thing on the call side. If you're selling a call, you're obligated to supply that stock at whatever strike price you happen to use. So in the case of actually in the case of Microsoft, if you sold a $100 call, all right, and the stock was trading at 95, you don't expect it to get to 100. If the stock goes to 110, then you have the obligation to supply that stock to somebody else at 100, which means you then got to buy it for 110 and you lose $10 a share. So that's important to understand, that there's a difference between rights and obligations. That's why selling is much more problematic unless you're using them in a spread. So when you buy, you are long a call, long a put. That's the expression that's used. So you can say I'm a long a call, long a put. That's when you buy it. When you sell a put or sell a call, you're short a call or short a put. That's the terminology. Buying a call, a long call is bullish. Selling a call, short call is bearish. Don't ever do this. Don't ever sell a call naked, which in other words, it's not in the spread. Don't ever do it just outright. It's very, very risky, very risky. So I would recommend against selling calls ever. Now you can sell puts if you want to own the stock at a lower price. The way selling a put works is called a cash secured put. If Microsoft's trading at 100 and you sell a $95 put, what you're doing is you're collecting premium because you sold the put, and you'll actually collect premium anticipating that the stock won't fall that far. If it's trading at 100, you're expecting it to stay above 95 by expiration date, and you keep the money that you collected. If it drops below 95, let's say it goes down to 92, then you're likely to be assigned the stock at 95. But that's what you wanted to do when you sold the put. In other words, you should not be selling puts, naked puts, unless you want to own the stock at the price or lower than what you're selling that put at. That's how you can accumulate stock at a lower price and collect premium along the way. So that's what selling a put is. Okay. Let's talk about what makes up an option premium price. And again, options can be at the money, as we said. In other words, if let's just take Microsoft trading at 100, then an at the money call or an at the money put would be at 100. You'd sell it, buy a $100 call or a $100 put. That's at the money. In the money would be if the stock's trading at 100, an in the money call is going to be anything below 100, and out of the money call is anything above 100. This price hasn't got there yet. So those are the terminologies that we use for the trades that we're doing: at the money, in the money, or out of the money. Now, what makes up the option premium? The price that you pay. Well, obviously the strike price is part of it. So again, I'm going to use an example here. If Microsoft is trading at 100, all right, and you buy a $95 call, all right, that call is going to cost you at least $5, because the difference between 95, the call that you're buying, and the current stock price, which is 100, is $5. So it's going to be worth at least $5. Then they're going to add on to that intrinsic value. The intrinsic value is basically, well, that is the intrinsic value. The $5 is the intrinsic value. So if you're buying a $95 call on a stock that's trading at 100, you have $5 of intrinsic value built into it. All right, so the intrinsic value makes up part of the premium price. The next thing is implied volatility. This is how much the market makers expect this particular stock to move. Is it very volatile? Is it not very volatile? The more volatile it is, the more premium it's going to cost you for that option. They're going to increase the price of the option with something called implied volatility. And the last thing they're going to add to it is time decay. How much time is there between the time I buy that option and the time it's going to expire? And the further out in time you go, the more it's going to cost you, because there's going to be more time in there. All right, and time decay is an important issue, an important concept in options, because it's exactly what it says. It decays. The value of the time is going to get less and less and less as you get closer and closer to expiration, which is it by itself is going to reduce the cost, or reduce the value of the option. So that's what makes up your option price, right? The intrinsic value, how much is it in the money? Now, if for example, Microsoft's trading at 100 and I bought a $105 call, that's out of the money. All right, so there is no intrinsic value. There won't be any intrinsic value until it gets to be at least 105. So all you're paying for is the implied volatility and the time decay. Now they seem cheap because they are cheap. They don't cost much, but the stock price hasn't got anywhere. So if that stock stays below 105, if you're buying a $105 call, the implied volatility and the time decay is going to keep decaying every day. So the value of your premium, or the value of your option, is going to keep going down in price until Microsoft starts to move up, and starts to move up past 105. So this is what's called out of the money calls, out of the money puts, and I recommend highly against it. You should always take in the money calls, in the money puts. All right. So again, intrinsic versus extrinsic, I covered it on that Microsoft, but let's just reiterate this. The intrinsic value of an option price is the in the money value. So a $50 option, a $50 call on a stock that's trading at 55, you have an intrinsic value of $5. It's important to understand that you want to be in trades, in options that have some intrinsic value in them. And extrinsic value is the option value, the value minus the intrinsic value. So if you bought this $50 option and a stock that's trading at $55, you've got $5 of intrinsic value. But let's say the option costs you $6.25. The extra $1.25 is called extrinsic value, and it's made up of implied volatility and time decay. That's why you pay more than the intrinsic value for the option. Okay, so that's the difference between those two, and it's very good to know that. The Greeks, we've talked a little bit about one of them. We talked about the delta, how much the option price moves in relation to the stock price. Stock moves $1, you have a delta of 50, means the option is going to move $50 or 50 cents, right? So it's moving half of what the option is. Now, as the stock price moves up, the delta is also going to move up because you're more in the money. The more in the money you get, the higher the delta becomes. So the delta itself is going to keep going up if the stock keeps going up, and it's going to go down if the stock keeps going down. And then you have theta. This is time decay. It's called theta. This is the decrease in the value of the option price as expiration date approaches. The less time there is to expiration, the less time that stock has to move, the less time that becomes a part of your premium. It's going to decay. And there are strategies that we use to take advantage of it. That's what credit spreads are. They're all they're doing is taking advantage of time decay. That's all. And then there's gamma. This is the last one I'll cover. This is the rate of change in delta. So if you take a $100 stock, and let's say the stock's trading at 100 and you've got a delta of 50, if the stock moves to 102, how much that delta moves, if it goes from 50 to 52 or 50 to 55, how fast that delta goes up based on that $2 move in the stock is called gamma. It's the rate of change in delta. And a high gamma means the option price can change dramatically with only a small price change in the stock. And if you've ever looked at options on stocks that are moving up, let's say the market opens and you get a $10 stock and all of a sudden it goes to $15 in 5 or 6 minutes. If you look at the option price, you're going to see astronomical moves in the option price. 2 reasons. The stock price has moved a lot, but the gamma has gone up a lot. So it's actually pushing the option price at a faster pace, and sometimes even faster than the stock. A lot of times if a stock goes from $10 to $15, the option that you paid $5 for is not going to go to $10. It's going to go to like $12.50 or $13. That's because of the gamma. Now, it's also important to understand that if the stock starts to compress and go sideways and start to come down, the gamma is going to drop just as fast. So the value of your option, when that stock goes from 10 to 15, when it gets to 15, if the stock starts moving sideways, your option premium is actually going to start coming down, even though the stock price has not come down. That's due to gamma. The gamma is changing the delta. All right. All right, so the primary option strategies that we use, long calls and long puts. This is pretty common. We do put credit spreads and call credit spreads. We also do put debit spreads and call debit spreads. The credit spreads, you collect money when you make the trade. Debit spreads, you pay for it when you make the trade. The calendar spreads, I mentioned, this is a time spread. This is what we do when we use earnings. That's the only time I use one of these. There's also called condors, which are basically put credit spreads and call credit spreads on the same stock. You're looking for it to stay in a channel. Butterflies, if you've heard of butterflies is a strategy where you're basically trying to identify roughly where the strike price or where the stock price is going to end at expiration. And then we do strangles and straddles. These are basically non-directional trades. Strangles and straddles are non-directional trades. Condors are non-directional, and time spreads are non-directional. All right, so here are the strategies based on bullish, bearish, and neutral, right? And these will be interesting to have. If you're long, if you like a stock long, this is what you can do. You can either do a long call, you can do a short put, not recommended unless you want to own the stock at a lower price. You can do put credit spreads, and you can do call debit spreads. Those are all bullish strategies, okay? For bearish options, you can do long puts, all right? So you're going to buy puts. You can do short calls. I put this in red. Please don't ever do this. Unless it's in a spread, please don't do this. It's really, really risky. You can get your whole account blown up on short calls. An example, Microsoft's trading at 100. You don't think it's going to get to 110, so you sell a call at 110 to collect the money, assuming that it's not going to get to 110 by the expiration date. Something happens overnight, and miraculously some company comes along and wants to buy Microsoft, and they're willing to pay $200 a share for it when it's trading at 100. And guess what happens when you wake up in the morning? You're short the call at 110. The stock's worth 200. They're going to exercise that. You're going to be sitting on the stock that you have to go out and pay $200 a share for to cover your $110 call on it. that could wipe out your account. And then you can do call credit spreads and put debit spreads. And the neutral strategies would be the condors, which I don't use much, straddles and strangles, and time spreads. These are all neutral strategies. Okay, I think I got a couple questions here. If theta diminishes the value, when should we get out of the option? Well, you know, listen, it depends on the where you are at the time. I mean, your option could have gone up a lot, and the time decay could be really minimal. I mean, because remember, the time decay is on the extrinsic value. So if you're in the money and you've got a delta of like 90 and 95 when at that point in time, the theta is not going to be very important because it's only going to be decaying on a very small portion of your position. Now, if you haven't got to your strike price yet, then that's when it becomes an issue, because now it's taking a bigger chunk out of your option premium every day, and that's where you have to use judgment on something like that. And it's, every trade is going to be a little bit different. There's no one rule to go by, but that's the important thing to know. Basically, if you're up in the money by deltas of 90 or 95, you know, it's probably not a bad idea to take profits. And if you still like the stock, you can always go out and buy something else that's got a 70 delta further out in time. Okay, all right. So those are the bearish, bullish, and neutral strategies that you can use for options. These are the setups. I'm not going to cover these. I have videos on all of these, but I don't want to confuse everybody on some of these things because you know, credit spreads, debit spreads, they're just buying a put and selling a put, or buying a call and selling a call to create either a debit or a credit. And they're all done in specific circumstances of stock setups, and they all have a place in the strategies that we use, the methodology we use, just dependent on the stock and the market, etc. All right. I will say strangles and straddles. I do like strangles and straddles. Again, they're non-directional. With a strangle, you're buying a call and buying a put, one strike or more away from the money. So when you do this, you're buying, if Microsoft's trading at 100 and you want to do a strangle on it, you do a $101 call and a $99 put. All right, you're buying them both, and you don't care which way the stock goes. You just want it to move more than what you're paying for the two together. All right, that's called a strangle. A straddle is exactly the same thing, except if Microsoft's selling at 100, you'd buy a $100 call and a $100 put. That's it. Those are using at the money options. These are slightly out of the money, both puts and calls. So those are strangles and straddles. And a big move on these can generate a lot of money. You know, if you can get a big move on them. Okay, so when you're looking at options, when you're going to buy an option, what's the best option? Well, these are just kind of rules of thumb that I go by. Use it in the money strike price. I would say always use it in the money strike price. Really important. Expiration date, go out at least 2 to 3 weeks, even for a day trade. If you're going to trade the stock and the option, you think that you're going to be out of it today or tomorrow, before this week, at least go out 2 to 3 weeks, because this is going to diminish the amount of time decay that takes place. Because the time decay, of course, will be much slower if you're 3 weeks out than if you're in this week's expiration. And try to find a delta around 65 to 75. I mean, there are other criteria. You've got to take a look at the bid-ask spread on the options based on the expiration dates, etc. But this is kind of the rule of thumb to use. All right, so I'm going to cover the trades that we've done in the room for this year, and I'm going to run through this fairly quickly. But there's a couple of things I want to point out. One thing I want to point out is these are the percentage gains on the trades that we took in January, and how many trades we took and how many losses we had. So we had 20 wins and 2 losses in the room. But you notice the percentage gains. This I really want to emphasize this. We had 65% in Miro, we had 96% in Boeing, but most of the time these things run between 10, 15, 20, 35%, something like that, around 40%. This is typically what you're going to see for profitability in your trades. And I point this out because a lot of services will tell you that you can get 4, 5, 6, 700% trading options on each trade. It's nonsense. You can't do. You can do it occasionally, but you can't do that consistently to make money. And the only way that you can do that is with out of the money calls and puts, way out of the money calls and puts that happen to really move. And good luck trying to pick out enough of those to actually be consistently profitable. It's not going to happen. So these are the percentage gains you see. So this was January. Again, 2,000 invested in each trade, netted 75.05. This is an arbitrary number, but I have to use something to compare month to month. Okay, on February we had 24 wins and 2 losses, 92% win rate. These are 2 really strong months, January and February. 2,000 invested in each trade, netted 11,745. I believe this was our best month of the year so far. I broke out the alerted trades here. We had 20 wins and 2 losses. The alerts produced 69.30 in profits for 2,000 invested in each one. Okay, so that was February. And again, you can see we have losses. Keep in mind, I emphasize here, we have losses just about every month. I think I've only had 1 month with no losses, but we have losses every month. We've taken a couple of losses in December already. Market's been tough. It's tough to trade it. All right, so just kind of a recap of 2023, because these are 2024 I'm looking at now. Investing 2,000 in each trade in the options room, produced a profit of a little over 60,000. All right, so if you had an account of 50,000, this is just arbitrary. Each trade used 4% of your account balance at the beginning of the year, and at the end of the year, the account balance was 110,000. So each trade would have only used 2%, less than 2% of your account balance. Just a kind of a benchmark to go by. But this is pretty much in 2023 we're up 60,000, a little over 60,000. This year we're up at the end of November in a little over 50,000. So we're pretty much on track to what we're going to do. In 2022 was the same. All right, so here's the first quarter of 2024. 65 wins, 11 losses in the trading room, 86% win rate. Alert service, 41 wins and 6 losses, 87% win rate. 18.7 for the trading room, 12.2 on the alert service. Okay, pretty good numbers, really. Second quarter, 65 and 14. Win rate was down a little bit, 83, but 14.8 profits. Alert service, 35 and 6. Quite a few less trades. 85% win rate, 11.7. Right, so those are the first two quarters. These are the May trades, and again, I've highlighted time spreads here because I used this in a webinar when I was going over how we trade our earnings, and we use time spreads. You can see the times. We had quite a few time spreads in May, of course, because that's when there was so many earnings were coming out. But in May, we had 15 wins and 2 losses, 88% win rate, netted 49.79. That was the alert service. And the room, we had 29 and 7. 81% win rate, lower win rate, but 57.36. So again, there's losses mixed in here. Here's June, same thing. See the percentages, how they stick right around the same way. 25 and 4, 86%, 75.90. And the alerts, we had a really good month, 14 wins, 1 loss, 92% win rate, 8,300. We made more in the alert service than we did in the room in June. All right, so I'll just kind of throw these quickly so we can get into the actual software and how we use it and how we identify institutions. But this was July, and alerts had 12 and 4, 3,300, 6,000 on the room. In August, you can see them here, 17 and 2, 8 and 1 in the room. Just 9 trades in August. August, very slow month, but again, still profitable, decently profitable. We've had a couple of losing months in the last couple of years, maybe 3 in the last couple of years, but typically not very big. All right, now to talk about the alert service. On what you're going to get is, on the alert, you're going to get the stock. Obviously, you're going to get the stock symbol. You're going to get the strike price. You're going to get the expiration date, and you're going to get the price to pay for the options. And this may be a range. It may say pay $1 to $1.10, or $2.20 to $2.30, something like that. And I would recommend if you get the alert and the stock's already moved too much, just put the order in at the original price that we want to pay for it, and wait for the stock to come back to it. Don't chase it. You can chase it a nickel or a dime, but don't chase it if the stock has moved really quick, because I don't know how fast the stock's going to move, obviously. Now, you'll get 1 alert when we enter the trade, and then you'll get at least 1 when we're exiting the trade. I may send out an alert that day, or I could send out an alert 2 days later. specifying the exit price, right? The take profits price. And then I may adjust that if things change. I may change the exit price to a higher or a lower amount. And then if we're going to exit it based on a loss, I'll send you out the exit price for the trade. If it's going to be for a loss, either loss, either gain, you'll be alerted to it. All right, now I want to talk about how, again, those results you saw were pretty impressive. Again, 85 to 90% win rate is average for the trades that we take. So how do we achieve these kind of results? Well, we're able to identify when institutions are driving a trade and when the market internals are heavily bullish or bearish. This is a key. All right, we only take trades when both of these are in our favor. Not 100% true. I'll take trades when the institutions are driving the trade, as long as the market internals are not against me. If they're neutral and the institutions are in, I'll take it. All right, so those are the trades that we're going to take. Those are the ones you're going to be. Those are the ones you're going to be alerted on. And how we do this, and how the Compass system or the SPY super system software. This is what the SPY super system software is. It does what's called a triple screen assessment. Listen, this is what some people call fractals. It's multi-time frame. We're looking across multiple time frames. This is the key thing for me, is the momentum. What's the momentum doing across multiple time frames? What's the trend doing? And what's the money flow doing? But we're looking across multiple time frames and all these. When all of these are moving in the same direction across multiple time frames, the chance that institutions are driving the trade extremely high, in the upper 90s, that the institutions are driving that trade right then. All right, so this is I just threw this up here. This is the Compass system, or the SPY super system. This is Thinkorswim. This is the platform it runs on. This is a 5-minute chart, but this just shows you an example of the indicators. This here is the multi-time frame momentum. This is the current time frame momentum. These are the two critical ones. This is the long-term trend, and this is the derivation of money flow right here. All right, and on the chart here, this little thin green line, that's the 15 EMA of an EMA. It's a smooth 15 EMA. It's less choppy than a regular 15 EMA. And these pop signals, these pink arrows, these are called pop out of the box or pop signals. These tell you when a stock is breaking out of compression. And they're very useful in identifying when to enter a trade. All right, so this is Tesla. This is what it looked like. But you can see the institutions. Anybody can see that they were buying the heck out of this thing this day. I mean, they were buying like crazy. All right, so that's what it looks like. So when we get to the more chart, you'll understand that, and I'll have these things labeled. All right, so I'm going to cover the SPY super system here. Now, this is for trades that are done intraday. These are quick trades. They're not really scalps necessarily, but they're fairly quick trades. And a lot of people like to trade these while we're waiting for setups to show up to take longer term trades. And I've been doing this for a while, but I didn't really introduce it to the room because, again, these are fairly quick. Typically, you have to be a day trader, and you got to have at least $25,000 in an account to trade these kind of trades, because you're going to be in and out maybe several a day. So if you don't have 25,000, you're under what's called PDT rules, or pattern day traders, which means you've got to be able to. You can only take 3 day trades in a 5-day rolling period, and you're going to be taking a lot more than that on this. So this is the SPY super system methodology that we use, trading the Qs, the SPY, and the IWM. I started doing this in July, the last half of July, and I'm now quantifying all of it. But we had 16-0, and again, I used $2,000 invested in each trade. Obviously, you can take more, you can take less, but this is what the results were based on 2,000. 25.96 profit in July with 16-0. August was a really slow month. So we're doing a lot of intraday trades off of the SPY super system, not very many longer term trades. So in the rooms, 56, 6, and 2, 56 wins, 6 losses, 2 scratches. 2,000 invested in each trade produced 82.01. September, 40 wins, 3 losses, 2 scratches. 2,000 invested produced 71.32. See, these numbers are pretty high. Now, it's important, I'm going to show you here in a minute, these are not included in the room numbers. Right? When I showed you these room numbers back here, these have nothing to do with SPY super system numbers. The SPY super system is not included in here, and I'll show you that in just a second. Again, October, 33 and 4, 2,000 invested, 48.31. See, the numbers dropped down here a little bit because we were spending more time on the swing type trades that we were doing. And with the key thing here is with the SPY super system, you're only going to have one trade on at a time, and they're going to be very short duration. So you have to watch the trade when you're in it. You've got to watch this trade because you've got to manually get in, manually get out, and it takes a little bit of concentration. And I can't alert on these. All I can do in the room is let you know when a setup is taking place, and I'll tell you when I take it. But these you've got to be nimble enough to get in and out of these on your own. All right, these are for people who like to trade intraday stuff and are nimble enough to get in and out fairly quickly. And they're actually able to read the system, which I'll show you in just a second. And this was November. I just updated this recently. 45 and 2, 2,000 invested produced 71.79. These are really good profits on this system. Again, it's critical that you stick to the criteria. Here's my October results. In the room, 17 and 3, 85% win rate. October, 14 and 3 for the alerts, 82% win rate. Again, 7,400, 6,000. Pretty nice October. We had a really, really good October. And now this is the October SPY Super System and the October room. And I just want to show you this to let you know that these are separate results. The October SPY Super System trade results, 33 and 4, 89% win rate. With 2,000 invested, produced 48.31. All right, that's the SPY Super System for October. In the trading room in October, 17 wins, 3 losses, 85% win rate, produced 74.48. So if you're doing these and you're taking all these trades, this is what your profit would have been, about a little over 12,000. So again, just so you know that this is separate from the room. The room is completely separate. This is a different strategy. They're very quick. You have to have be a day trader. You have to be qualified as a day trader with at least 25,000 in your account. But they're great. It's a really nice way to trade to kind of enhance the amount of money that you're making while you're waiting for other trades to take place. Here's November. November was a decent 14 and 2. Number of trades are down. There hasn't been an awful lot of good trades. 14 and 2, 88% win rate, and alerts 14 and 1, 93% win rate, 59.58 in the room, and 78.03 in the alerts. The alerts did better than the room in November. And here is the November SPY Super System results. Again, they don't include the room results. Here's the SPY Super System, trading the SPY, the Qs, the IWM, 45 and 2, right? 95% win rate, 71.79 that I just showed just a little while ago. The November option room trade, 14 and 2, 88% win rate, 2,000 invested, 59.58. Here's your profits for the two if you trade the SPY Super System and this. Now it's important to understand this since I don't alert on these, because I can't alert on these, they're too quick, and I can't even post them. I just call them out. These are the trades that I took based on the ones that I mentioned in the room. All right. Everybody else's results may be better or worse. I mean, I have quite a few people that are making a lot more money than I am on the SPY Super System because they're focused just on that. And they're not, I'm looking around for swing type trades all day long. So they focus just on this, but the criteria is very critical. And I have a video on the criteria for the SPY Super System that shows you exactly how to trade it. But I'm going to show you some charts now on this with the SPY Super System or the Compass system. So what we're looking for. All right, so here is the Compass system or the SPY Super System on Thinkorswim. Here's your platform. Looks really busy, right? But I want you to understand for the SPY Super System, this is the current time frame momentum right here. See this arrow pointing to that? This is the only indicator down here that we're interested in. We're following just this. Red and yellow is bearish, blue and green is bullish. All right. When a stock switches from red to blue, that tells you that the institutions are going on the current time frame. They're going from selling to buying. Now, right here is where I identified that. You see that arrow? This is where I took the trade. This pink line is the volume weighted average price, the VWAP. That is one of the criteria that we use. All right. The other one is this 15 EMA. These become my support and resistance levels that I'm going to key off of. So when this broke above the 15 and the VWAP right here, and the institutions went from selling to buying, this is where we bought the trade right here. All right, I bought this and I followed it. Now, as it moves up, the 15, which is the green line because it's moving away from the VWAP, this becomes my stop. So I stayed in this. Now, you get a little bit nervous when it does this red candle. But you notice that this has gone from blue to green. This is bullish. So I stayed in the trade, and this is where I get out. When I started getting dojis, and I get out right here, and that was $220 profit per contract. This was back on August 9th. And you're not going to get tons of trades that are more than $200. Most of the time, they're going to fall in the $70 to $120, $130, $140 range. But this was a pretty good trade. But it gives you a nice view of the actual setup, because it looks busy, but this is current time frame momentum. This is multi-time frame momentum. This is what we use on the swing trades, looking at the daily chart. But for our 5-minute trades, SPY super system trades, this is what I'm looking at, right? And there's the VWAP, the 15 EMA. That's all you really need. That's what you follow off of. Richard, when I say 2,000 invested, if there's a loss, the whole 2,000 loss? No. I mean, it can be. When you take an option trade, they can go against you 100%. But in my mind, I'm always figuring that's my max risk. But typically, no. But most of our losses are going to be bigger than not on the SPY super system. SPY super system losses are very small. But on swing type trades, they can be larger than that, because we're staying in the trade based on technicals. And as long as the stock doesn't break down, I'm staying in the trade. So you could have 50, 60, 70% loss on a trade. But again, if you're maintaining 85 to 90% win rate, that's you don't like it, but you don't want to. I don't want to be getting out of trades because I'm down a certain percentage or a certain number of dollars if the stock is still bullish. I've done that before, and it didn't work out because I gave up a lot of trades. I exited a lot of trades for loss that if I had stayed in them another week, I was up good money on. So that's what I'm looking for. But yeah, you can't lose the whole 2,000. Listen, anytime you enter a trade as an option trader, most option traders, the first thing they think about is how much money they can make. How much money I can make if this stock goes up 10 points, I can clean up on this. What you should be thinking about is how much money can I lose on this trade. That should be the prime focus when you take a trade. We support and resistance levels, and how much am I at risk here? How much can I lose? Okay, so that's a SPY super system trade. Here's another one. I've got a few examples of these. And so I kind of want to put a bunch of them on the screen so you can kind of see the setup and identify them. But here's what I took here. It moves sideways, it's compressing, everything's green. Obviously the institutions are buying the heck out of SPY here. So I bought it right here as it basically bounced off the 15. I took it right here and I rode this thing up. As long as it stays above the 15, I'm in the trade. See, the 15 is right here. It stays above the 15, and this is where I get out. Starting to get a little bit of weakness here. See how I got a yellow, went from green to yellow. I took the trade off, $130 profit per trade. These are fairly common for these kind of trades. The choppier the day, the shorter the trades are going to be. This is another one. This was an IWM. This was an 11.15, $90 profit per contract. Get in right here as the stock compressed. See, it went yellow, blue. Okay, selling, buying. It had been buying, they went to selling, went back to buying again. So I took it right here, and it pulled back on me immediately. But I'm still in the trade. It's still green, and I'm watching the 15. As long as the stock price stays above the 15, I'm in the trade. It wasn't doing much, but I stayed in it. I stayed in it, and this is where I get out here on this red candle right here, right? Because I had a decent profit in it at the time, and I get out. And you notice that as soon as it broke down, it went back to yellow again. This is another SPY super system trade here. Red, institutions are selling. We know they're selling the IWM here. We look for an entry right here in this compression. It breaks down below the VWAP right here. Right here. So this is where the entry is on this trade. You just take it here. And then you write it down. Now the VWAP initially is your stop. And then as the stock starts to move down, the 15 becomes your stop because it's moving down. Right? So you just stay in the trade here and stay in the trade. Now it tried to get above the 15, didn't make it, but I wrote it down to here and then I get out. You see how this went from red to blue, selling to buying, I'm out right here. All right, $120 of profit per contract on that one. Another one here, and I'll just kind of throw these up on the screen so you can see what they look like. The whole point here is to be able to identify this and see how easy it is to identify it. See the break below the VWAP right here, right? And the stock it doesn't go anywhere. I'm still in the trade, still in the trade, still in the trade. See, it's staying below the 15. 15 red line, I'm staying below it, staying below it. It gets above it and it comes back again, stays below it. Then I get a nice flush and I keep it here and I get out right down here. All right, this white line is called a pivot point. This is something that the compass system or the SPY super system produces, just like these pop signals. So I have to be very cautious when it gets close to the pivot point. It could be support. I watch it. If it bounced off of there, I'd get out, but it flushed right down again. Okay. Couple of questions here, Josh. Does the SPY super system have an option to back a few days to see in securities what is it doing? I don't mean, I am not understanding what you mean by that. Go back a few days. Example, can you look at Broadcom and how SPY super system signaled? Yeah, you obviously, yeah, you can go back and look at the chart. Depends on whether you're looking at a daily or a 5-minute. But I mean, this chart, and I'll show you the live chart. You can go back in time, a long way. You can see exactly what was happening at any point every 5 minutes during the day, and see what it was saying. Yeah, absolutely. And you look at it on the daily chart too. I'll show you some daily charts. All right, so there's the IWM right here for the SPY super system. Again, compression went from red selling to blue buying, so I'm waiting to get a breakout. I get a breakout right there in that little pink arrow, pop out of the box, I buy it here, and I ride it and ride it and ride it. I stayed in this thing. Again, the 15 became my stop, and I get out right here in this red candle. $150 a contract. That was pretty nice. All right, so now I don't have any arrows. So just so you can see here, this is the SPY, and you're looking at the setup here. What do you see? Right. Well, you see here, this went from red to blue, selling to buying. See what that arrow is right there? But do I buy it here? I do not, because it broke through the 15. But see the VWAP right there? That's resistance. So I stay in. I wait for this to break. This is where I get into it right here. It only went up 4 candles, and I'm out. Okay, I get out right here. So it didn't produce an awful lot of profit, but you're going to get a lot of them like this. It stays green, but I'm out as soon as I start to get these red candles and lock in my profits. IWM, same thing here. Just look across, see it's green. See it went to yellow and then back to green again. A lot of compression here. Where would you likely buy this? This is likely where I would buy it right here. And then as long as it stays above the 15, I stay in it, I stay in it, I stay in it, and then I get out right here on this big red candle. I could have got out here, but this is like right there. Right, and there's a SPY. This was the one that I want to point this one out because I do trade counter trends sometimes in this. Now, I'm taking the SPY short here. Notice it's red. I'm taking the SPY short here as it breaks below this VWAP, the pink line, the VWAP. This is where I buy it. So I'm in here and I get 2 candles, 3 candles, and then I get a hammer basically here. I'm out as soon as it starts to do this. So this is not much of a profit, but it's it's probably somewhere in the neighborhood of $60 or $70 a contract. And then I'm out. But here, see it went from red selling to blue buying. It popped above the VWAP right here. As it went to blue, this is where I actually went long here. All right, and what I've got is a stop looking, I'm looking at stop at this pivot point up here. So I buy it here. It's blue, so now they're buying again. Now I'm riding the 15 and I just ride it up, and I get out right here actually. Because I didn't like it was just getting this close. And I had a decent profit in it. But that's how you find these SPY super system trades, and it's really not, you've got all the indicators here that you need. You're not looking at a lot of things. If you're looking at this one, you notice you're getting a lot of color changes here, but nothing really helpful. And then you finally here you go to from green to red or yellow, which is bearish, as you break below the 15. This would be a place to take it. I mean, you might have considered going long here, but notice it was still red. So when time went blue, it was a little bit too far extended for you. At least it was for me. So I waited for this breakdown and took this trade to the short side. Like I said, you have to be, these are subjective trades. You've taken them. You've got to take them yourself. I can't give you entry points and exit points. But if you're a good trader, you like to trade a system like this. This is perfect for you. All right, and this is more of them again. I'll move along here, but again, you can see you see how it goes from red to blue to green, but we're below the VWAP. We're looking for a break above the VWAP. We get it right here. There's your entry as it breaks above the VWAP. You don't really want to take it as it breaks above the 15 because you've got the VWAP just above too close to resistance. All right, so those are the SPY super system trades. Now I do want to cover some of the regular trades that we take. These are swing type trades, intraday type trades as well, but these are not SPY super system trades. These are based on the daily chart and then the 5-minute chart within the daily chart. All right, so this is Palantir. This is when we took in 10-8, 31% profit. This is a daily chart on Palantir. Now you see the indicators here. Now these become more important. I'm interested in the multi-time frame and the current time frame. They both need to be green or blue for long. So this was switching back and forth, and the stock was moving sideways. This is where I took the trade as it went to green here, as it broke out. There's a little shaded area you might not be able to see. This is called the dynamic compression zone. It was breaking out of compression. So I took it right here and I get out right here, 31% profit in 2 days. Okay, Twilio, same type of setup. Notice I went from yellow to green on the multi-time frame. The current time frame was already green. Took it right here as the stock basically moved off the 15. Took it right here and wrote it up. Just for 2 days, very, very quick trade. This was a call debit spread. We did 58%. CRM. Now this one here is a little unusual for me. Notice it's compressing, but notice it was still yellow here on the current time, on the multi-time frame, but the current time frame was really a lot of green here. So I took it because it was breaking out, and it was a bit more risky, all right, because of that. But it did move nicely, and it switched back to green again, and I took profits 29%. Lulu, this was a call debit, a put debit spread that we had overnight. And it gapped down on earnings. I didn't take it there. I waited for it to compress. Usually I wait till after earnings have settled down a little bit. Then we took it right here as it went to, see, we went from blue to yellow. The current time frame was already red. It went to yellow, took it here and rode this thing down. 56% profit, just an overnight trade. This just this one little night was good for us. A couple of questions here. Will the system work on NQ? Absolutely, it works on the NQ. Or the Q. I mean, you can use the NQ, the ES, the Russell 2000, either with the futures or with the regular ones. I use the SPY, the Qs, and the IWM. But you know, it'll work on any of the Qs or the Russell or the 2000 or the SPY off of ES or NQ. Yeah, it works on the QQQ. A lot of these trades were Qs. I don't put everyone up there. What I typically say is in my criteria, yeah, you can trade futures with the system. Absolutely, you can. Yep, the system, the futures work perfect on it. If you've got a platform you can trade futures off of, Thinkorswim you can trade futures off of, Trader you can trade futures off of now, Ninja you can trade futures off of. But the Compass system itself, the SPY super system, only gets installed on Thinkorswim. There is another one called Money Flow Tracker, which can be put on Ninja, but it looks different. And I'm personally, I like the one on the Compass on the Thinkorswim, but the data is the same. But I don't trade off of Thinkorswim. I trade off of Tradier. I'm not interested in trading off of Thinkorswim. I trade off of Tradier, but all my indicators and all of the information I need to just decide whether to take a trade or not is coming off of my Thinkorswim platform with the Compass Super System or the SPY Super System on here. Yep, you can trade futures. Yep. Why did I stop trading futures? You know, why did I stop trading futures? Well, I can't really trade futures during the day when I'm doing a room and I've got SPY Super System trades going on. You know, I could be trading the ES, but I don't do that. Futures, when you're trading futures, first of all, there's a lot more leverage when you're trading futures. If you're trading futures, you know, you can take micro contracts, but you're trading futures, so there's a lot more risk at the time, and there's a lot more movement. And typically, if you're trading futures, you're normally trading on a shorter time frame. I mean, I used to trade it at night. You know, when I get off trading during the day, I trade at night. But you know, listen, I needed a little bit of a break from trading. What system does my software work on? It works on Thinkorswim or Ninja 8. Ninja 8 is called the Money Flow Tracker. On Thinkorswim, it's called the Compass system or the SPY Super System now. SPY super system, and it runs up. And this isn't what Ninja looks different. Ninja is presented differently. Ninja is typically a platform for trading futures. You're not likely going to be trading stock off of a Ninja. What is the name of the broker I use? Spell it, please. It's Tradier, Tradier. Tradier. And again, the reason I use Tradier is because I pay $10 a month, flat fee. I don't pay any commissions on options or stocks. And option commissions can add up. If you're doing a lot of options, I mean, I obviously trade thousands of contracts a month. You know, even 25 cents can add up to quite a bit. So that's why I use Tradier. All right, so there's Lulu. We talked about that. Here's Workday. This was another nice trade. This again is off a daily chart. Yeah, notice again another one that went from blue to yellow, and then back to blue again. But the current time frame was blue. I used my judgment on these as the stock was breaking out of this dynamic compression zone, and took this for a 5-day trade and made 30%. GC. This is another one. GCT 2-day trade, 26%. Everything green. Everything's being bought. MDT, again, another one. We got blue here when I went into it. Went back to yellow, then went to blue again. So this is where I entered as it came along this 15 and then broke above there. And again, this is a daily chart. And I didn't get much movement in this for a good long time. It ran along the 15, but everything was still blue and green. So I stayed in it. Then I got a pop and I went ahead and took profits in it. VKTX, same thing. I want to get to a couple of 5-minute charts. This was a nice overnight trade, by the way. This was in McDonald's. Again, everything, you can see that buying McDonald's, everything's green. It popped out of this dynamic compression zone right here. I took it right here. I get out right here. Overnight, in at 8:30, out at 11:30. $830 a contract went to 11:30 a contract. 37% gain. Amazon. This is a 5-minute chart. This was an intraday trade. I was looking to get on it. Again, it was bullish. It was bullish on the daily. It was also bullish on the 5-minute. I took it right here as it bounced off the 15. Could have probably taken it right here. I took it here. It bounced off the 15, and then I just stayed in it and stayed in it, and was in it for 45 minutes and made 32% profit in a 45-minute trade. ENPH, nice short. A lot of compression here. Everything red. A lot of selling. Take it right here as it breaks down below the 15 and ride this for an hour and make 20% on it. Stays below the 15 the whole way. Everything's being sold. This is telling you the institutions are selling this. This is what's so critical. Rain is David Kushner using system software. He's using the money flow tracker on Ninja, and he trades at quite a bit different system than I do. But he does have a methodology he uses over there using the money flow tracker, which is basically the same indicators. But he's trading off of I believe off of a much faster time frame than I do. A lot of times they'll use Unirenko over there, or they use a range chart. Again, I'm using 5-minute charts for my day trades. Okay, and as Verizon, this was a nice 50% profit. This was beauty. Verizon it doesn't move a lot. This was cheap in options. I actually bought the next week's in the money options. It was slightly in the money. I paid $45 a contract right here. And you can look at how short, look at the selling. I mean, is this going down? Well, the institutions certainly think it is. They're selling it like crazy. So I bought it right here at the VWAP, and I rode this thing down for an hour, and the $45 contract went up to $67. So from $450 for a 10 lot contract to $670 for a 10 lot. That's pretty nice for an hour. All right, and this is just a SPY super system setup that I used to have this chart in before I actually broke the SPY super system out separately. This was Tesla. This shows you I can actually use it overnight sometimes. I had a pop out of the box signal on the 5-minute chart on the end of the day. And again, it was coming below the VWAP. Everything looked bearish. You see, we had yellow here, red here, so it was bearish. So I took some puts overnight, and we got a little bit lucky. The stock dropped from 112 to 120 to 112 overnight, and we stayed in it till down here, and we were up $7 or $8 a contract. That was a pretty nice trade in Tesla. Okay, so those are the charts, and that's the Thinkorswim platform that we have the SPY super system loaded on. And again, here's just a recap of what we do in the room, the different strategies we use. Covered this already. And here's these offers again. This is the one I showed earlier. You can get right now that it's really a good deal. You can get the trading room and the alert service together. Typically they're separated, but you can get these things together, and you can start with a 3-month, a 2-week trial if you want, and then you switch over to a 3-week subscription. If you want to get it cheaper, you just go to the annual subscription, and you get them both for $17.94 for a whole year for the trading room and the text alert service. And you saw what kind of results we're getting. Now, if you're in the room, of course, you're also going to get the information that you need for the SPY super system as far as trading it within the room. And if you get the software, you can have that yourself. You can be trading the SPY super system yourself off the criteria, off the video that I do that shows you how to do that, and what we just covered. You can do it yourself if you've got the SPY super system loaded on your Thinkorswim platform. So here's the annual access here, and then over here, this is a one-time payment this is forever. This is you're in the room, you're in the alert service forever. So it's just a matter of how much time you want to have. This is for people who want to try it out, but then they're going to go to quarterly. If you want to just get the annual access, you can just pay. This is obviously a lot cheaper than the quarterly one. And this is the software. If you're interested in the SPY Super System software, what's also called the Compass Trading System Access, that's the software that we just looked at. It goes on Thinkorswim, and it comes with a bunch of scanners, and I'm going to show you a little bit about that in just a second. The installation is done by Rightline, by their tech support down there. They take over your machine, they plop that on there. It's going to look exactly the same as mine. A lot of people buy this stuff. Again, that's an annual subscription. You get a month in the options trading room and a month of the alert service, and you get a scanner. I'll show you how the scanner works. That's the annual, and this is the one-time payment for a lifetime. You buy the software, you own it forever, with the same information here. You get access to all my videos as well. All right. So if you have any questions, please put them in the question box or on the your name and number, or your Skype username. Rory will give you a call, or you can call Rory, and I'm going to check for any more questions we got here. And I am gonna drop this just for a minute, and let me check one thing here. Inside the chat box, there should be links. Yeah, inside the chat box, there's links to the offers. Okay, so all the offers we just covered, which is this is the trading room and the alert service together, and this is for the software itself that goes on Thinkorswim, called the SPY Super System. All right, and let's see if we get any questions here. Okay, so I'm going to drop this down so I can show you something here. All right, so this is my platform. This is the Thinkorswim platform with the SPY Super System on here. All right, right now I'm running. This is the queues. This is the queues from yesterday, because this obviously market's not open now. But you can see the indicators: multi-time frame momentum, current time frame momentum, derivation of money flow, and trend, multi-time frame trend here. Okay, long-term trend. Here's the VWAP. Here's the 15, exactly what we looked at. Here's some of the scanners. I've got 3 of them running here. This is a cascading up. This is looking for relative strength stocks on the 5-minute. This is cascading down. This is looking for relative weakness stocks on the 5-minute. If I click on the symbol, it's going to switch to the chart and show me the chart. If I want to see how Google looks on the daily, I just switch to the daily. And here's the daily chart, and here's what I'm looking at Google. Now, you see this big push up in Google, but notice that the multi-time frame momentum is switching back and forth, and it's blue, and this is green. This is looking like a long. This is like a pullback opportunity, looking for Google to pull down and move up again. But it's yellow previous to yesterday based on this pull down right here. But this is telling you that it's actually the institutions are actually buying Google right now. Okay, there's Wolf. There's another one, very choppy. You can see the choppiness and the different colors. So that's what you can look at when you're looking at these. These are some cascading up. These are just the 5-minute charts. Yeah, this cascading up scan And cascading down scan is also, you can also look at for dailies. If I switch cascading up over here, cascading up in the daily, it's going to repopulate another. It might not, because Thinkorswim is under maintenance right now. Yeah, it's not going to work. They're under maintenance at the moment, so I won't put that. But that's what that would show you. It's going to show you those. So that's the chart. Now, if I go back over here and look at the triple Qs, because I did trade some SPY Super System triple Qs trade yesterday. All right, so here's the triple Qs. Let's go back a little bit. This is back to yesterday morning. Right here. So here is the open on the triple Qs right here, gapped up. We had a gap up yesterday, and I don't take them that early. I just watch. But what I'm looking for here is I'm looking for some sort of a setup. Now notice I've got red here and yellow here. This is what I'm watching. So this is a short entry right here. As it breaks down below the VWAP and the 15, that's a short. See how it's red? And so you write it down. And then when it starts to flatten out, you take your profits as soon as it starts to bounce up again. So there was several opportunities yesterday. Now I actually traded this thing long yesterday, and this is where I took a trade in it. See how it says green here, but I'm waiting for it to get above the VWAP. I could have taken it here as it got above the 15, but the VWAP was too close. So I waited for it to break above it, and I took it right here, and made some decent money on this one. This was moved up pretty nicely. So that was just trading the Qs. You know, you can, but that's what I look at during the day, and I would have pointed out we got a break here. You can see the break. You can see it's green. Time to if you want to take a trade, this is the time to do it. But be nimble. And again, if it breaks and closes below the VWAP here, you're out of the trade. So your downside risk is really limited. If you're putting 2,000 into a trade, you're never going to lose all of it on this. You shouldn't be down in typically more than 30 or 40 cents on these for the most part on these particular trades, unless you get some sort of news event or a flush or something. All right. So we'll go back to the field. So that's the webinar. I hope was helpful to everybody. I appreciate you being here on a Saturday for that. And again, the offers that, and you can go out to you can call Rory and he'll talk to you about them as well. But that's where you are. I appreciate it. Thanks so much. Josh, thank you for being here. I appreciate it. Good to see you. Hope to see some folks in the room or on the alert service coming next week. All right, everybody, have a great weekend.